November the, I forgot what day it was, November the 14th, 2023. We will call the meeting to order. I know for the roll call, Laura Kelly resigned from the pension committee. Paul is not here, and also Todd is not here, therefore we do not have a quorum. So we can't vote on the minutes, but we will go through all of the Mariner reports. I want to remind you that the next meeting will be February 20th. We had to change that date from our normal schedule due to training being held here on site, so it'll be February the 20th at 10 a.m. So we'll turn that over to you, Pam.
All right, thank you, Nikki. It's great to be here and meeting a few of you for the first time, so welcome to you, and we're happy to be here, of course. But Mariner Wealth Advisors is managing the investments for the pension plan. We don't do anything beyond that, so the specifics to the participants and all of that is handled separately. But we do this each quarter and like to give you an overview of kind of how we're investing and why and how the investments have done. So the presentation that you should all have, the first few pages are always just kind of a review of who we are as a firm and the updates that we've had. Mariner Wealth Advisors, as a reminder, is a registered investment advisory firm, which means we are a fiduciary for all of our clients. And that is very important since we are legally obligated to do only what's in your best interests. We take that very seriously in everything that we do. We're a fairly large company nationwide. There's a map on page 3 that gives you an idea of where our offices are, but we are also very local here in Kentucky. So Michael and I are coming to you from our Louisville office. We're very hopeful to have a Lexington office someday in the relatively near future, but we're very active in Kentucky. I'm on a number of different boards and things, and we're very happy to be here. Both of my children are here too, so we're happy to be here. But our firm in total manages about $100 billion in assets for clients nationwide, so we do have a significant depth of resources that go into everything that we do and our investment strategies. So if you turn to page 5, this is an executive summary of your investment policy statement. This is the summary. The full document is on the several pages behind that. But as a reminder, the investment policy is yours, and that is the governing document that we use to make sure that we are investing according to your objectives and your guidelines. As a permanent pension fund, this needs to be able to pay participants in perpetuity is how this is viewed. So it's very important that it grows over time, but that also has some degree of stability and is not too incredibly volatile. So to do that, we have a balance between the stocks and the bonds and the cash. The target and the ranges are shown here. Stocks ranging between 50 and 80%. That is really the driver of growth. We have to invest in stocks to have growth in the portfolio. But as you all know, the stock market can be quite volatile sometimes, so we build in a cushion. So the portion that's in bonds and cash is there to help cushion the volatility of what we get from stocks. We do earn interest on those, and so that's a different type of return. It's very stable, but it's a lower number. So we balance those two together to get that overall portfolio return that is providing that what we call moderate growth over time that this kind of plan really needs to have. Everything else about the investment policy is just designed to make sure that it is very well diversified. We don't have too much in any one investment, very high quality. We want to make sure that everything is substantial and something that we can be comfortable with, and just items related to that is what these other details are. So I won't go into more detail unless there are questions, but the full document is here over the next several pages, and if you'd like to take a look at that. So if we turn to the next section behind that divider on page 17, starting here just with an overview of the market environment that we've been in. Page 17 is looking at a variety of different kinds of stocks so far this year. So this is just for the first 9 months of 2023. This is coming after a year last year that was very, very negative. We had a down market in 2022 that was predominantly driven by higher inflation and therefore higher interest rates that set off kind of a reaction among stocks That is a concern over, what happens to the economy? Do we get a slowdown? Do we get a recession? That has been anticipated for actually a pretty long time that we've not yet seen. The economy has held in there. We've had a very strong job market. We've had a lot of things that are continuing to move pretty well in the economy. But with higher inflation, as the Federal Reserve raises interest rates, their goal is actually to slow down the economy so that the inflation slows down, is kind of their tool that they have for that. So there's a lot of watching right now to see signs of things slowing down, inflation in particular. We actually had just this morning at 8:30 the latest inflation report, which was a very good one in that it was a very low number. So the market's up really big today. So it's a very close watch on all of that to see how that plays out. But for the stock market in general, so far this year, we've seen a variety of different returns. So different kinds of stocks, anywhere from up 2 to up 13% this year, just kind of depending on what it is. Large company, small company, US, international, there's been a lot of different nature of things. The very highest here you'll see is the S&P 500 in green. Through the end of October is written off to the side on the right. Up 10.7% compared to the Dow Jones Industrial Average is blue, is only up 1.4%, shows you the pretty big disparity we've had this year, predominantly because the S&P 500 has become more and more tilted towards the very large technology stocks. So it's starting to reflect a lot more of that. So those stocks have done very well this year, and so you're seeing a little bit more of a dispersion between those two than we would typically see. The next page is also kind of market overall, but this is looking at interest rates, which is reflective of the bond market. So this is looking at U.S. Treasury bond rates. If you see on the bottom, from 3 months maturity all the way out to 30 years, and 3 different time periods. So the line on the bottom, that dark gray, is what those rates were at the end of 2021. So that was December 31st of 21. You can see interest rates were all very, very low. A 10-year bond there in the middle was 1.5% was the interest rate on a 10-year bond. The green line is what was a year later at the end of 2022. You see they had all moved up. The blue line there on top is what they all were at the end of October of this year, and you can see that rates have continued to get higher and higher. They are very high now compared to where they've been, and kind of the interesting dynamic is that the shortest maturities have actually a higher rate than the longer maturities, which is very unusual. You usually think of having a longer period of time, you're either investing or borrowing, you're going to have a higher rate than a short period of time. That's normal. That's the relationship you see on the bottom. When it's reversed like that, we call that an inverted yield curve, which is just terminology to say that short maturity is higher. And it's basically the bond market predicting perhaps a recession, but predicting that things will change relatively soon to where interest rates will actually come back down, which is why that investor in the 20-year bond is willing to take a lower rate than the 3-month bond, because that person thinks that rates will be coming down and will wish we had that. It's kind of why that happens. But it historically has been the predictor of a recession. We've had an inverted yield curve now for over a year. We've been expecting that we could end up in a recession. Whole market's been expecting that. So if at some point here they say, yep, things have slowed down enough, we're declaring that we're in recession, we would say just that by itself would not be enough to create a huge market reaction. It would be kind of what's been expected to a degree. Depending on the nature of it, we could of course get more of a reaction if they're saying it's just awful, but chances are we kind of know that before we got to it. But that's the environment that we've been in. Now the other thing about this, when interest rates go up, when we're holding bonds in an investment portfolio, the bond prices come down if we wanted to sell that bond, because those bonds have a fixed interest rate, and if you want to sell something and all the other rates have gone up, you're going to get less for it. But when we buy bonds in your investment portfolio, we are holding them until maturity. So it's like a CD. We've got a set amount, we've got a set interest rate, and we know the date that full amount comes in. So even though rates can change and the prices of the bonds can change, so the market value officially is perhaps lower in a negative return, when we hold that bond until maturity, that full amount comes back. So it's just kind of on paper for a period of time. So, but that's kind of the dynamic that we've put in. If you turn to the next page, this is the summary of the portfolio. This is as of the end of October 31st. The pie chart is the asset allocation. So this is showing the amount, the proportion that is in stocks versus bonds and all the different kinds of stocks that are within that. In total, we have 74% within the stock portion of the portfolio, but you can see how that's divided among many different types of stocks, so it's very well diversified. The other 26% is in that bond and cash portion that is the cushion, really kind of protecting from the volatility. The returns, the performance of the portfolio is in the upper right-hand corner. We've actually had a pretty nice bounce here through the end of October. The total portfolio has had a return of 7.8% for that 10-month period. Below that are the two pieces, the fixed income and the equity, which is the stocks. So the stocks are up about 10.2%, while the bonds have had a 3.3% return. And then as a reminder, we've already seen last year was a negative year. The whole market was down. So the portfolio was down 12.4% last year. But a reminder, the year before that was actually very strong. It was up 16.9. So we've had a bit of a zigging and zagging there. And then that longer term 10-year number is always annualized. So it's an annual equivalent of 6.4% per year over the past 10 years. So we would say this portfolio is doing what it's intended to do. Yes, we're going to participate when things go down as well as go up, but they are creating that growth over time, which is the goal. Okay, any questions? And then just one other page is kind of an accounting. This is just kind of the past 3 years to show kind of where we started the year from an investment perspective, cash flows in and out. So payments are going out on a regular basis to the participants. And then the sources of return, which come from dividends and interest, and adjustment that happens with bonds, and then the market value increase or decrease. So just a bit of an accounting over the past 3 years. Okay.
The next page is the individual stocks that we own in our actively managed portfolio. So there's an active and then there's a passive strategy. The active, our investment team researches these companies all day, every day. It equates to about 68% of your overall equity exposure of the equities. So the other 32% is in our passive strategy, but I'll get to that in a second. We categorize these stocks into 3 different categories. So on the far left, we have our growth and income. These are our steady eddies, our dividend payers and dividend growers. These companies are typically less volatile as measured by beta. So beta, anything less than 1 is less volatile than the overall market. So we'll hold these positions typically a little bit longer than others. The middle category is our cyclical growth. These companies are more opportunistic. We may be in and out of them quicker. They ebb and flow. These types of companies ebb and flow with the economic cycle. So that is why they are opportunistic. And then on the far right, we have our high growth stocks. These stocks are fast growing relative to the business that they're in, the company that they are, or the industry that they're in. And as you can see, we have more names in the high growth category. But part of our active strategy takes advantage and we can shift allocation from one category to another, from high growth to cyclical to growth and income. So far this year, growth has been a really good performer. So we have more names in that. But as things evolve and as things change, the number of names can shift across different categories. The next page shows our top 10 equity holdings. I like to call this our risk control slide. Really, we're looking for stock concentration risk. In your investment policy statement, we have, there are certain restrictions on how much we can hold in a certain company across your entire portfolio. And we're well within those bounds, even with Apple being at 5.28%. But that's the percentage of the total equity, not of the overall portfolio. But as you can see also, we have technology, we have energy, financial services, and then the total cost is the cost basis, what we paid for that position, and the market value is the growth. So there are a handful of positions that we've held for quite some time that have been very profitable. Arista Networks, United Health Group, just being a couple that have been really nice performers. NVIDIA as well, they're up over 200% this year. So all within the investment policy statement, which is good. On the next page, it'll go a little bit more, not in depth, but it'll show the different sectors that we're invested in and the diversification that we have in the portfolio. Technology being 29%, but you can see we have diversification across all sectors, which is what you want to see in a portfolio. So nothing out of sorts. This is about where it was the last time. So everything's well diversified. Next, I'll go into the passive strategy. So on the next page, you'll see 4 different exchange traded funds. You can see large cap, we have a growth index and a value index, Russell 2000 or small and mid cap, and then the international EFA. These companies have many different companies in them. So on the active piece, we have about 50 names. On the passive piece, we have a few thousand collective. But you can see the different columns year to date, the differences between the large cap growth and the large cap value index. Growth is outperforming, as I mentioned on the past few slides. But last year, growth was not as great. So it's nice to have a balance between growth and value on the passive side. And then you can see the performance going back a handful of years, and then the average 10-year annualized return for those ETFs, but also comparing the indexes that they correlate to. So everything's in line there as well. The last page that I'm going to cover is our bond review. This really just shows the amount of bonds that we have that are maturing and in what year they will mature. Because, as Pam alluded, because interest rates are higher on the short end, we've been a little bit more favoritive to shorter term bonds within a few years. So as you can see, a vast majority of the portfolio matures within the next 3 years. As those bonds mature, we'll take those funds and look for other opportunities in a higher interest rate environment. So as you can see, we have a well-diversified bond portfolio as well. Some, just to note, the 2049 and 2099, those are not corporate bonds. Those are preferred stock. So they're still, it's like a hybrid security. So we're not holding those to maturity. And it's also, as Pam alluded, we own individual corporate bonds. When we buy a bond, the plan is really to hold it to maturity, collect the interest, and then once it pays out, once it matures, we'll then take that and reinvest it. So, are there any questions about any of that?
Okay, and then that last section behind tab 2, we just like to provide some perspective on what we're seeing in the economy and the market and our outlook. So on page 27, this is just looking at, when we talk about the economy, we're referring to gross domestic product, GDP. GDP grows at a much slower pace than the market. I know a lot of times we kind of talk about both of them together. But GDP, we're seeing here for the past 20 years or so, has grown by an average of about 2% per year. Sometimes it's above that, sometimes it's below that. In the box above that, you see just the past 4 quarters and what those reports were. You'll see the most recent was actually very strong. So the third quarter, we actually had a 4.9% growth number. On the right is just the composition of that GDP, and it's an important reminder of how much is driven by consumers and consumption elements of the economy. So that is usually about 2/3 of our overall economic activity is consumer-based, which is why we put a lot of focus on how the consumer is doing. On the next page, a big part of how the consumer is doing comes from, what's the job market look like? What's the labor market environment? This chart is looking at two different things. The dark gray line is the unemployment rate, so how many people are out of work and looking for work. You'll see that is a very low number right now, well below the long-term average, below 4%. But we're also seeing on the blue line is what has wage growth looked like. When we have a very low unemployment rate, yet a lot of employers are looking for people to hire, and that's the environment we've been in, that can lead to employers needing to pay more to attract people and to keep people. As that cost goes up, it can lead to them also raising their prices to cover that cost. So the tightness of the job market is one thing that is really focused on by the Federal Reserve and by a lot of folks to see, what is likely to happen to inflation in the future. If it's a really tight situation and we're likely to have that rising cost, then rising prices is viewed as a source of potential inflation. So we had that environment earlier last year. You see how high that blue line got to a 7% kind of year-over-year increase in some of that labor cost. We have seen that growth rate come down closer to its long-term average of about 4%. So that's viewed as a positive from an inflation standpoint. So it's good to see that. On the next page, we're looking then on page 29 at CPI. When we talk about inflation, usually what we're looking at is the consumer price index and how much that has changed over the past year or just over the past month. This is looking at it on the year-to-year change, looking back for 50 years to put that in perspective. But you can see here recently that we got to a very high point last June. We've seen that come all the way back down, getting closer to the Fed's target, which is actually 2%. We're still at about 3%, but it has definitely moved closer to that and in the right direction. We like to see that number getting lower. Now that does not mean prices have come down. Prices went up a lot and then they've just not continued to go up a lot, but we've not seen them revert back to where they were. The next page gets into more detail. This is a busy chart, but it's very helpful in that it's a heat map. So the colors tell the story. So when you see green, it means it's low. When you see red, it means it's high and of concern. And then there's kind of variations between those. The top set of numbers are that year-to-year change. So every month they're looking at what are prices now compared to a year ago. You see the September report was a 3.7%, so that was comparing to September of the prior year. The next set of numbers below that are just the month to month. So how much in September, how much more are prices compared to just in August, so just incremental monthly amounts. What you'll see is that for both of these, we hit the highest point middle of last year. So June of 2022 was the highest. That monthly incremental numbers ever since then, so last June it was 1.2%. It's been mostly green and yellow almost every single month since then. The report today came out at 0. So that was a good thing to see too. So October is a very low month. But it takes a while for that, if you're comparing it to a year ago, you have to have 12 months of 0 to then have it look low for the next year, or to be low. But below that, you see the different components. So these are what goes into that CPI. Basic categories of energy, food, core goods, and core services. And it's interesting then to just kind of see, where has the red been and why, which areas were high and when. It is not the case that it's like everything went up and, did it all together. It's been kind of different stories behind all of it. It started with the pandemic and coming out of the pandemic where we had a shortage of things. We had factories that had closed. We had, ships lined up at the ports. We couldn't get supply of goods while there was still plenty of demand. So that created a big jump in prices of core goods, was really the first area. Then we move into early 2022. We had Russia invading Ukraine. That was a really big deal for oil and for grain. because those are two products that there's a lot of that have been coming from that part of the world. So again, cutting off the supply while demand was still relatively strong created a spike in prices for those items. The last piece of it really was in the core services, and that is for part of that traditional reason of having very strong employment. The economy is growing very strongly, and so there's just a lot of money going into a lot of things and pushing those prices up. But in all of these cases, it has, we would say, knock on wood, has pretty well worked its way through the system. We're mostly seeing kind of greenish here for the past few months, and so that's encouraging. But it is a wait and see time that we're in. It takes time for higher interest rates to have the impact on the economy and on the inflation rate. So again, we're watching to see, hopefully if we have a recession, we would expect it to be relatively mild, but we won't know until we see it play out. The next page on 31, when we're invested in stocks, we're very focused on what are the earnings or what are the profits of those companies. This is looking at the whole market in total, but what is the projection for the earnings or the profits that these companies are earning? The three blue bars on the right are just the projection for this year and the next 2 years. The point here is that the projection is that they're growing. That is still the expectation. That is a positive for stocks in general as we look at where are they likely to trend. When earnings are growing, that's a good time to be invested in stocks. The next page is an important one that we show you every time, but it's a reminder of how often the market does pull back. We refer to a correction as being the market down by 10% from the last high. That tends to happen on average about once a year. So this is just looking at that. It goes back to 1980. The gray bar and number is what the stock market did for the full year, up or down. But the red number underneath is showing what was the largest drop that occurred at some point during that year. So if you focus on those red numbers, there's not every year that we get a 10% or more pullback, but more than not we do. And the average of all of these is actually a 14% decline. And a lot of them are very quick. We'll see a big drop, but then things bounce back and finish the year quite positive. And we tend to forget, when it happens that quickly. So I think it's helpful to see, looking back, how often that really does happen. And then the last page that we'll talk about is on page 33, our forecast for the year. In January, we come out with a forecast for the calendar year. We did that this year. We were expecting a pretty strong market, especially because of how weak it was last year. Getting to June, we had seen a very strong return for the first half of the year, so the investment team said, okay, based on where we are in June, where do we expect to be next year in June? So kind of a forward 12-month look. And the expectation here is that, yeah, we could end up in a recession. If so, we expect it to be mild and short-lived. We're expecting that interest rates will probably remain relatively high, maybe come down a little bit. But with that, our investment team has put the most likely probability on this base case, 60% probability that we have a really kind of normalized return from June to June, is what that number represents. So if it's an 8% price return for stocks, we add dividends to that, it's a 10% return for stocks is the expectation, which is kind of the average return. Always a possibility, of course, of it being higher than that or lower than that. It's not a crystal ball, but it's just kind of putting our best efforts into what do we expect from just a probability standpoint. So it's a good time to be invested, but invested in a balanced manner, I guess is how we would put that. So plenty of volatility to come. We've got an election coming up. There's all these things going on in the world. But the one more thing I'll say is how important it is, and most of you know this, is so many things we see on TV, and there's all these things happening, and it can feel awful and all of that. But the market is not the same thing. It's important to separate it and realize that it's a vehicle for investing in stocks, for investing in companies that are making things, doing things, selling them to people who are buying them. And as much as all these other things can be disturbing and all the other things that are going on, it doesn't necessarily mean it has to flow straight to the stock market. We've got to remember what it is and what it represents. And and it still can be a good time to be invested. So we will stop there.
Thank you very much.
Any questions?
Yeah, anyone have any questions? Steve, you have any questions?
No, other than you have a 7.8% return year to date
Mm-hmm.
to October.
Yep.
Okay, that's great. Thanks.
Yeah.
Okay, thank you all very much. We do not have any old business or new business that I know about unless anyone has anything. Okay, and I guess we will stand adjourned. Thank you all so much. Appreciate it.